Welcome to Insights. I'm Eric. I want to have a discussion today about money, credit, and debt. It's coming through the headlines today as Yellen's giving her testimony to lawmakers, encourage them to spend a lot of money and to ignore debt as if it's somehow a novel approach. I have been watching the financial markets ignore debt since I've started watching the financial markets. It's a part of the late cycle phase for the U.S. empire, so to speak. The Fed has been a part of going big since Greenspan introduced first started expanding the balance sheet in order to liquefy a system and to prevent insolvency in 2003. It really took off. And what we have here is a chart between the M1 money supply and the Fed's total assets. And when you compare the two, when the balance sheet starts to expand, when you have a downtrend or a downward push of these red boxes, the Fed's in balance sheet expansion mode. It's buying treasury market treasuries, U.S. Marketable treasuries. It's buying junk bonds. I mean, mortgage-backed securities. It's all over the place. We'll take a look at it in a moment of what the composition of what they're buying as time has passed. But they're trying to, each time a red box forms, they're trying to support an ailing system. Now, Yellen's suggesting that if we just go back and keep spending money and ignore the debt, somehow we're going to repair the system. But as we're going to see in a moment, the damage is expanding. In the next chart, we see the Fed's balance sheet, which starts in 2003 and moves upwards. In the red boxes, again, these are the expansion periods, and you can see where the Fed's balance sheet is expanding. We're still in possibly one of those expansion phases. The computer says maybe it's slowing down because it's M1, the Fed's balance sheet is slowing down relative to M1, so it suggests there might be a pause here, but this could just pick back up again. But what we want to focus on here is this line down here, which is the ratio of the Fed's marketable treasury securities divided by the Fed's total balance sheet or total assets that they're buying. So in 2003, when they really didn't buy much treasury securities. About 2003, right about here, they started picking up some purchases, and I think this is about 2007, they really started to buy treasury securities, and it was a part of the equation to re-liquefy the system. But I guess the trend that I'm trying to point out is this downward movement from here to here. Right here was zero. And then when they started buying treasury debt, it was mostly treasury debt that they were buying in 2007 to 2008. That was a part of their balance sheet. That was when you see balance sheet expansion from here to here, it was mostly treasury debt. But as we progressed from 2008 and they continued expanding their balance sheet, what we find is it's less and less treasury debt and more illiquid, high risk or distressed assets, whether it be mortgage-backed securities or junk bonds. I mean, the Fed, you'd have to dig into the Fed's balance sheet to find out, and even if it's disclosed. But the point is from here to here, you're looking at now it's like 40% of what the Fed's balance sheet is market securities or treasury market securities. It's becoming less a part of the stabilization effort. The Fed's actually moving down the food chain in order to support the system. It used to do that by buying the treasury securities, whether they be short-term or long-term. But now it's becoming less part of the plan. As we go up here, as we gooseneck higher, far less of the purchases was treasury market debt and something else. That something else is more speculative, further down the food chain, corporate, probably completely illiquid, potentially worthless debt. And it's bailing out a system that's becoming more and more fragile. So the suggestion that we're going to get out of this and return to normal by just expanding. Who cares about the debt and do whatever it takes? As the Fed continues this, I would assume that they will continue expanding their balance sheet because they'll never be able to liquefy or sell it out of the market. It's a large sum that they probably will never be able to unwind. It's unrealistic to assume that debt's going to solve this problem. And the problem is fairly significant. Here is money, and then take a look at the velocity of money, which is how much how much money is being created relative to the income. So the top line would be GDP or national income relative to the money supply or money stock, which would we use M2, which is the biggest measure that the Fed still publishes. We are now lower than the level we saw in the Great Depression, which means that we are creating a lot of money, but it's not turning over into national income or GDP or gross domestic income. And the lowest we saw was 1946 and 2020, and now in the early part of 2021. These are annual figures, but they're updated. We're probing below both of these lows here and there, which suggests that whatever the Fed is doing in the Treasury, even if they do go big, we're not doing anything. We're spinning our wheels and we are grinding lower. So eventually what will happen is the only thing that's going to turn the velocity of money higher is a failure of confidence in the system, and eventually people will start to spend that money because they don't want to get caught holding it. But we might not be there quite yet, so that might be a couple more years out before this deflationary trend turns into an inflationary. Ultimately, we'll end the U.S. dollar as the core currency for the core currency of the world and for the core economy. It'll have to be dumped and something new will have to come up. So that's how I frame today's testimony by Yellen. It's really nothing we haven't heard before. I suppose everyone's going to view it as bullish for inflation or bullish for the stock market, but ultimately I think it's just the same. The stock market could continue to go higher based on all this debt creation as long as speculation continues. But if the velocity of money doesn't turn up soon, there is a potential risk of a deflationary force unfolding. It's already got the economy probably turning down to 2022. I don't know how much longer the stock market can hold up against it. So thanks for watching this discussion. If there's any comments or questions, you can contact me directly through the blog, or subscribe to these videos and comment below if you would like to. Until the next review and something maybe an individual market, try and have a good trading day.